We want you to plan for success. Welcome to Planning Matters Radio.
Hi, Peter. Good to see you. A really important question today. Is a home value correction coming? And I want to just jump right into it because this graph is incredible. Mortgage payments as a percentage of income jumped to 70%. That's according to the Census Bureau and Mortgage Bankers Association. I mean, Peter, these numbers are just hard to comprehend.
It's frankly scary, Erin,
Right?
that homeowners are extending themselves so far beyond what is a reasonable cost of living. We want to see people fix their home prices within an affordable range in their budget. And long term, that's just unsustainable. Really, my target is about 25 to 30% of your gross household income is kind of a reasonable price for housing. But to look at that price or that percentage going over 50% to 70%, that quite frankly is scary. And to me, eerily reminiscent of some of the things that we were seeing happening prior to the Great Recession.
Right. So let's kind of break this down for a second. What led to this storm?
Well, I think it was the shortage of homes on the market. I think it was the competition for those available homes. I think it was the fact that a lot of people did have a lot of discretionary income. There was a lot of money pumped into the economy. If we rewind the tape back all the way to 2008, the Fed has been in a mindset that they needed to stimulate the economy by pumping a lot of liquid, accessible, and cheap money into it. And to the tune of 3 rounds of quantitative easing and COVID stimulus, $14 trillion of next to free money being pumped into the economy. Interest rates continued to fall over that period of time. And if you look back to the end of 2021, I mean, you could lock into a 30-year interest rate at around 2.25%, 2.5%. Today, those rates are up closer to 5.5% to 6% already, and the Fed's not done adjusting their rates. So what created this was all of the available capital that's out there chasing so few homes. And we all saw the news of the bidding wars. I heard that in the month of June alone, there were 360 homes across the country that sold for at least or more than $1 million over asking price.
That's
so the bidding
incredible.
war really still is going on to some extent because inventory is still so limited.
Right. My goodness. So some experts say that we are either going to see a substantial cooling of the housing market or material wage inflation. Is there one that you think is more likely to happen? And is there one that's better for homeowners?
I don't think it's necessarily an either or. I actually think that a bit of both are probably necessary. And I don't think that homeowners will love it. But at the same time, I think it's the one that may be more healthy long term is that home prices cool, that we do begin to see a reduction in home values. Let's face it, they were overinflated at the end of last year. I looked at a chart of my home's value over the time that I've owned it, and it was growing. The line was going up, but in 2021, it just ballooned to an astronomical level. It was up about 25% in that year alone, and that was the trend nationwide. That is unhealthy and unsustainable, and it's creating unaffordable housing conditions. I mean, rent also is higher than most people who are in that phase and in the renting phase can or should afford. And so I think that we will need to see some wage increase and some wage inflation. But I also think that eventually we're going to see, because of interest rates rising, demand cooling slightly, the amount of home that people are able to afford cooling slightly, and therefore some amount of cool down in the actual home prices. And you know, in the financial world, Erin, we recently talked about the relationship between interest rates and bond values.
Yeah.
There is a similar relationship between interest rates and home values. If investors want to sort of think in a microcosm of how can I relate that a rising interest rate environment will actually lower the value of my bonds, just think of your home. A rising interest rate environment means that people can afford less home or less home payment, and therefore the prices have to cool a little bit.
Mm-hmm. So I feel like this whole conversation, though, begs the question as to whether now is a good time to buy, because for the first time in a while, it feels like buyers at least have a little bit of, wiggle room right now.
If you need to, I think absolutely. I mean, historically, these interest rates are still pretty attractive. I remember having conversations with my parents back in the 80s and 90s, double-digit interest rates. Now, more people were savers back then, so we were benefiting from nice rates on CDs. But when you did have to take out debt, for instance, for a mortgage, you were paying a hefty amount for it. And 5.5% and 6% rates may seem like, wow, that's so high. But in historical perspective, that's actually still a pretty attractive rate for a large loan like a mortgage. Compare that to your credit cards, where you're happy to charge something on your credit card that's costing you 16 to 24%, right? These are still very attractive long-term rates. And if rates do begin to cool and come back down, you can always refinance.
Yeah. Right. All right. Well said. I'm glad we had this conversation. Clearly very important and very relevant. If somebody has some questions about this, what's the best way to reach you?
Give us a call at Richon Planning. You can reach us at 919-300-5886. You can go online, richonplanning.com. That's my last name, Richon. Looks like richonplanning.com, Richon Planning. And you can also email me, Peter, at richonplanning.com. Happy to talk with anyone about any kind of financial related questions that are on their mind.
Yeah, that's great. All right, Peter, thank you.
All right. Always a pleasure, Erin. Thank you.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.